Yeah, it's you're building up a reserve to buy the next one when the term ends. So if you do like a 1 year term, then Freddie wants you to have that reserve to then buy it for the following term. But as the price of the rate caps go up, so does that reserve to keep up with it.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
George has been investing in real estate for over 15 years now. He started in single family, small multifamily properties, and eventually worked his way into large 100 plus unit multifamily properties. They have acquired over 8,000 units to date. George, welcome to the show.
Thank you. Excited to be here.
Absolutely. It's a pleasure to have you on. If I recall, and I'm going back, I don't recall, what was it here, George? The last time you came on this show, May 19th, 2021. That was episode number 171. I don't know what this will be when it comes out, but we'll be in the 700s. So it's been a while since we've connected and caught up. I'm glad to have you back on the show just to hear kind of how things have changed from that point till now, where you guys are, what you guys are doing. So if you're listening to this today and you want to hear kind of George's backstory a little bit more, go back to that episode again. That's episode number 171 on May 19th of 2021. Nevertheless, George, it's great to have you back on the show. Thanks for being here.
Yeah. Just a little's happened since, right?
A little bit. It's been a busy last, I guess this has been in, what's that, 18 months? My math is probably bad here on the fly, but close to 18 months. So tell me, where are you guys now? What are you guys working on? What's the state of George and his company?
Things got a little crazy this year with the Fed raising the rates, and we had a lot of plans for ending this year pretty strong, which I feel like we still are, but we've had to make a lot of adjustments on the type of deals that we want to take down and how we're going to structure those, how we're going to structure the capital stack. The lenders are tightening up. Rates are a lot higher than they used to be. Just getting creative, man. We're, I never thought loan assumptions would look this attractive.
Right.
But yeah, they sure are. So we're asking every seller to carry back some of their money if they're willing to. So getting creative.
Getting creative. I want to hear as much as you are willing to share on that topic. I know you said that you're kind of adjusting the structure in the capital stack. How are you changing that capital stack? I know you touched there on asking the sellers to do seller carryback. Anything else come to mind that you guys have adjusted on that front?
For sure. So, I mean, we've seen opportunities popping up. We think they're going to continue on. There's going to be a lot more opportunities coming next year as well. So for us to put a deal under contract right now, one, we got to feel comfortable with the basis, a low basis of entry. That's been a struggle on itself, right? Trying to get these sellers to reality. So it's been a lot of submitting offers and kind of just following up and staying in front of them. And then what we want to do is we either want to have that loan assumption, like I talked about, at a low interest rate. If not, we want to see if going in with agency is a possibility. The leverage is going to be really low when we do that, most likely, depending how much value we need to add to the property. But if not, we got one right now that we're going to be doing a local bank at a fixed rate. Just trying to avoid those adjustable rates at all cost, the really high rate caps. So and then filling that gap, right? So if our loans are coming in at, let's say, 55 to 60% LTV, then that's where we're going to ask the seller if they're willing to carry back some of their funds, then possibly bring in some private equity, JV equity, fill that gap, and then finally come in with the GP equity as well as some of our investors. So it's become a little bit more work, but I've been through a down cycle, and I know the last time we kept buying and everything we bought turned into gold later.
When you start changing the capital stack that dramatically, it really, in my probably uneducated opinion, changes the dynamics of the return profile. How are you doing that and still producing respectable returns, or I guess attractive returns, perhaps I should say, to your investors?
Yeah, man, I think it goes back to some of those things I mentioned, right? So a seller carry, when we're asking a seller to leave some of their funds in the deal, we're asking for some pretty attractive terms. I mean, we've gotten some at 4%, 6%. Not a 2-year balloon either. We're talking about like a 10-year balloon and give ourselves space. So when you do that, it increases the returns, right? Same thing with if we're bringing in a JV equity or private equity partner. We've been able to. We've got one partner right now that we use quite a bit, and they're at right around 11% all in, down to a 6 or 7% on the current part of it, right? And then the other piece gets accrued. So that also helps with the returns. And then the expectations of our investors, we've kind of come down a little bit on that, especially on the IRR and some of the equity multiple. We're still trying to hit that 2x, but yeah, just it's still better than putting it in the bank, right? As far as the the returns you're gonna get. And as long as you're with an experienced operator, I do think operations is going to be very, very important through these times.
Yeah, and that's a great point. And I was reading something earlier that said something about whatever the particular asset class was, and it said buying in this particular asset class beats Wall Street any day. And so it just kind of, playing off of what you said there, is better than putting the money in the bank. Maybe those return profiles are shifting, and I think it's going to take a little bit of us training our investors to say, hey, downplay your expectations, because we've really ridden a really good ride for a while, but
Yep.
it's still a good place to be. I was talking to another sponsor here recently, and this is a topic I am relatively ignorant on, so I will need to have your help in kind of filling the gaps. He was talking about interest rate caps and how they had, and maybe you can explain this for me and then tell me how you guys are avoiding this if it has affected you at all. But he was saying, hey, we had a property and they were paying like $1,800 a month for the interest rate cap, whatever, and now it's costing them $18,000 a month, to the point where the property is now no longer solvent. And I said, my gosh, like, how did that happen? I didn't quite understand that. Can you tell me about interest rate caps? Is that something you guys have exposure to? How does that work? And is that, how has that changed now for you guys, if at all?
So usually you pay for it up front, right? So a lot of the ones that we have.
It was an interest. It was reserves, I think was the word he used.
Okay. So we got one deal that has that. It's a Freddie floater, and it's got the reserve, and yeah, it's gone up quite a bit. We were pretty shocked, but we've been able to add enough value to that property where it's not an issue. But yeah, that's just one. On the other ones that have a rate cap, it's we purchased it on the front end, and most of them we did pretty well on because they're paying out more than we paid for it.
Got it. Okay, so there's a reverse way that could potentially. Again, I have no exposure to this personally, so which is why I don't understand it, because I've never had to deal with it.
Yeah, it's you're building up a reserve to buy the next one when the term ends. So if you do like a 1-year term, then Freddie wants you to have that reserve to then buy it for the following term. But as the price of the rate caps go up, so does that reserve to keep up with it.
Got it. I needed an explanation on that. See, if you're listening here, there's always something to learn, and that's that makes a lot of sense, because I asked that sponsor to explain it, and they couldn't quite put it in words that I could grasp. I'm like, wait, huh? I'm confused here. So there you go. That makes sense. So when they have to re-up their policy, then they've got to
right. So if the Fed comes out and softens their approach on this, right, then that reserve should start to go down as well.
Right. Right. Wow. Yeah, that makes a lot of sense. Well, good. Well, I'm glad to hear that you guys don't have a lot of exposure on that side. You said that agency debt has a low leverage. Is that always the case, or is that just unique to the way or the market conditions right now?
The market conditions, because the way they're sizing up the deals on the exit of it is lowering their leverage on the entry. They still say the 70 to 75% or whatever, but when you actually size up the deal, you're more at like 50, 55%.
Okay. And that's do you think that's all bad actually as a deal sponsor to have lower leverage?
No, absolutely not. It's just how you going to fill that capital stack, right? And what returns are you going to um, have your investors expect? And uh, obviously, there's more equity, so that dilutes the returns.
Right. Right. That's the downside. Diluted
Yep,
returns, but the upside is less exposure,
for sure.
on the debt side of things. What do you think opportunities are coming? How are you guys positioning yourself for the opportunities you see coming your way?
I think we kind of positioned ourselves already with a lot of the main brokers on the fact that when we put something under contract, we're closing.
Mm.
We have that track record. So when there's an issue on a deal, is when they usually come to us, um, which is where we want to be. We're also reaching out to other vendors, debt brokers or the lenders themselves, and kind of just putting that in their ear, like, hey, we're here. Like, let us know. We know it's maybe you're not taking properties back right now, but
Mm.
you're having conversations, and we want you to think of us. Uh, so kind of just positioning ourselves in that way. I do still see a lot of opportunities. We're doing a lot of Class A stuff right now, where we're buying straight from the developer, and we've had a lot of success with that. There's still a housing shortage, right? Like that's still a thing. And yeah, a recession is going to affect that, but depends where you're at.
Yeah, no, absolutely. Tell me about the Class A. That's a really interesting. Probably not the thing I would have expected you to say. So,
Yeah, I mean,
why Class
we
A?
um well, one, it's a lot easier to manage.
Makes sense.
Yeah, and if I'm looking at a Class C, especially, so when the gap between the Class C and the Class A during this whole run we had in the market, that margin began to shrink, right?
Hmm.
Like when you're buying, so we bought end of year last year, we bought a Class A deal for I think it was about 180 a door, and Class C deals were selling for 130, 140 a door. It's like, it didn't make sense,
No.
right? um, so that's when we started looking at it a little bit uh, harder and going after more of them. And as far as adding everybody always says, well, how are you going to add value to that Class A deal? And it depends. Like, look, a lot of developers are there to build these apartments, get them filled as quickly as they can, and get rid of them. They don't want to operate them. They don't want to push rents. They don't want to see how much other income they can put in there. And so, I mean, that's what we specialize in, right? So we come in and we say, well, there's this much gap in the market rent that we know we can take that opportunity, and then we know we can implement, let's say, internet or whatever it is, all this other income, and I barely have to do any renovations. Versus a Class C, I'm almost going to increase it by the same, but I've got to do a ton of renovations, and I have the risk of all this old plumbing and old electrical. So yeah, that's
That makes a heck of a lot of sense to me. I mean, I wouldn't see a reason to invest in Class C with those dynamics that you just mentioned. That it just doesn't pencil.
yeah.
Have you seen any softening in the Class A demand?
Not so much, at least that's another thing, we make sure that we're positioned to not have to be like an A+
Hmm.
product. We're really pushing to get the top of the market rents. With our properties, we have not. We've been able to continue to increase rents and haven't had any issues.
That's awesome. No, very cool. I love the way you think and just kind of your overall approach to how you arrange debt, how you arrange your equity stack, or the capital stack as a whole. The types of assets you guys are buying. It seems like you've put a lot of thought and have moved pretty methodically through this process. Does that sound about right?
Yeah.
Tell me about this. I know you guys are, if you are methodical, and if you are, I know you said one of the things that you guys are working on right now is that you're reaching out to, various people in the industry and saying, hey, look, if there's stress in the market, keep us in mind. Is there anything else you're doing right now that's kind of that pre-planning or just positioning yourself, maybe not necessarily taking action, but positioning yourself for a change in the market?
Yeah, I mean, there's a ton, right? So, like I mentioned before, we're talking to a lot of our vendors that we have relationships with already, and just reminding them, hey, we're still here. We plan on continuing to be active. We want to buy a lot of deals next year, and you need to come to us if you have something, right? We're also making sure we line up uh, large equity partners.
Hmm.
So, building those relationships, even if we're not putting a deal in front of them, we're just kind of touching base with them and letting them know that we're ready, and for them to be ready when we bring them a deal. And that's it. We work a lot with, we have other co-GPs, investors that look for deals for us too and bring us deals. So kind of just letting them know exactly what we're looking for. Um, and then hopefully all that comes together.
Right. Yeah. It's not necessarily the one ingredient that makes the recipe. It's a whole bunch of things all at once.
Yep.
So that's really, really cool. I love that. One last question for you there when you talked about lining up large equity. How do you position large equity and say, hey, in the future I want to have or we may have an opportunity for you? Is that patient capital, or is it, I guess, in my lack of understanding, I would say that they're like, hey, this is going to work, and if it's with you, not with you, it's with somebody else because we can't have it sit here.
That is true with like an individual, right? If it's a 1031, or let's say somebody sold a business and they've got that money sitting there. Not necessarily for some of these larger private equity firms, right? They're constantly raising equity, or if it's a family office, they usually have a good chunk of money to move around. So more of that level, and kind of just hey, let's get vetting us out of the way, right? What do you need to know? How do we skip that whole part? Because we want to be able to bring you a deal and move quickly.
Right. I love that. I love that. Laying the groundwork early. Very, very cool. George, thank you for taking the time to come back on the show here today. Certainly appreciate it. Loved hearing your market, just kind of sentiment or your view on where the market is and how you guys are positioning yourself to take advantage of the next opportunities coming your way. I've enjoyed it thoroughly. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Best way to do that is they can check us on our website. So if they go to elevatecig.com, stands for Commercial Investment Group. So elevatecig.com. Or if they want to shoot me an email, it's George or Jorge, Jorge, at elevatecig.com.
Fantastic. We'll make sure we include both of those there in the show notes. And George, thank you again for coming on. Certainly appreciate it.
Thank you, Sam. Appreciate it.